All right. Hi, everyone. Thank you so much for joining our Market Matters stream today. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I am joined, as always, by our senior markets correspondent, Bob Pisani. And today we're going to be answering all of your questions and everything you want to know about the stock market. So nice to see you, Bob.
Hi, Katie. Sorry about the delay, everybody. A little bit of technical glitches here, but we got it.
We're up and rolling now. So lots to get into today. So first up, Bob, you were out in California at the Future Proof Conference. What did you learn? Who did you talk to out there?
Well, I'm a old friend of Barry Ritholtz and Josh Brown from Ritholtz Wealth Management, and I think very highly of them. And they had a conference last year in Huntington Beach, which is sort of the surf capital of California. And they had 2,000 people there, mostly young investment people, RIAs, registered investment advisors. This year they got 3,000. And what I think is interesting about this conference is they're trying to invert some of the old tropes about going to financial conferences. Number one is you put them in some convention center in a room, and you have a speaker in the morning and a coffee break, and then you have lunch, and then have more speakers, and then you have a cocktail party, and everybody goes home. It's kind of, these things are getting a little old and boring. And part of the problem is, how do you attract new investors, younger people, other than just industry professionals? So their idea was, let's turn this thing upside down. Instead of just doing meeting after meeting and content and speaker, blah, blah, let's make the social interaction as much a part of this whole thing as the content. So let's have a lot of cocktail parties, meet and greets with young RIAs, meet and greet with professional companies. That's not a presentation, it's a cocktail party. Let's have hip hop. Let's bring in Method Man from Wu-Tang Clan and Redman and G-Love and Special Sauce, and play some old rock and roll. And what happened is, the RIAs who come to this thing and other investor advisors tend to be younger, I'd say 30 to 45 years old, typical, and they show up. And they do come for the social interaction. So yes, there's a quasi party atmosphere and you're on the beach, but it's lovely. And I think very highly of it. And I had a very nice panel session. I did an interview with Jeff Kleintop from Schwab and Emily Rowland from John Hancock and Jeremy Schwartz from Wisdom Tree. And we signed copies of my book. I have a book out, Shut Up and Keep Talking. 200 people showed up to the book signing. It's pretty good. So I think what the takeaway here is that it is possible to sort of update these conferences for the 21st century and make it a little more interesting for everybody. That's sort of the bottom line.
Well, it sounds like a great event, so I'm glad that you were able to get out there and speak with everyone and have a good time. So next up, Bob, we're into September now, mid-September. How have stocks been doing this month?
Well, it's kind of living up to its expectation of the worst month of the year. We're down about 1%. It's not bad this week, but this is a seasonally weak time of the year, particularly September and October and even August. And it generally tends to improve the seasonal trading patterns in November, December, January. There's a couple things going on in the next few weeks. So today is a triple witching day. You'll know this. This is a quarterly expiration of individual stock options, index options, and index futures today at the close. So S&P 500 index options and index futures are all expiring. But more importantly, usually what you get at the end of these things is the week after this expiration in September is traditionally a weak period for the next few weeks. There's an old phrase here, sell Rosh Hashanah, which starts tonight, the Jewish holiday, and buy Yom Kippur, which is, I think October 25th or 26th. September 25th or 26th. So there is a seasonal weak pattern here for second half of September and into October. And then generally it gets better. The bulls like to point out that the fourth quarter of a pre-election year, which is what we're going into, it's the fourth quarter of a pre-election year, is traditionally a very strong period. So you have these market timing things. You have some of these seasonal market timing things. The sell Rosh Hashanah, buy Yom Kippur, the weakness after the triple witching, the strength in November, December, and the fourth quarter of a pre-election year, all kind of coming together. So the bottom line is a lot of people are expecting some weakness in the next few weeks, and stronger patterns in November and December. What's curious about this is if you look at the VIX, which is the volatility index, the expectation of volatility next month, it's very low. It's near a 3-year low. So it seems like a lot of people are not terribly worried about seasonal trading patterns. This may be because, well, it may be because the soft landing is winning. The economic data is still strong. Inflation is coming down, not fast enough for enough people, but still coming down generally. And so that would certainly overwhelm any seasonal trading patterns. So the answer to your question is September is a very difficult month to figure out, but generally the period we're in now has traditionally been weaker. And if you go back 25 years, you'll see almost 2/3 of the time, after the triple witching, September in the next couple of weeks tend to be down.
All right, well, we'll see where things go from here. So Bob, this week we got some new inflation data. What did we learn? What does that mean for next week's Fed meeting? What did we learn?
I don't want to bore everyone with the numbers. The numbers, and the problem with inflation numbers is the Fed has a preferred inflation indicator, the PCE, personal consumption expenditures, and there's also the CPI, the consumer price index, which are similar but not the same thing. To add to the confusion, there is core and there is headline. Core generally strips out food and energy, which are considered very volatile, and yet most people use food and energy. So the Fed likes looking at core, excluding food and energy, but most people actually don't live life that way. The bottom line is all the numbers are continuing to come down. Some of them are not coming down fast enough. Some of the wage numbers are still fairly sticky. And that's why you should pay attention to things like the United Auto Workers strike, because they're asking for very large wage increases. So this battle is, I would say, not won on inflation, but progress is being made. Enough progress so that the market believes that the Federal Reserve is either going to be done or maybe one more rate hike. The camp's about split evenly. Nobody thinks the Fed's going to raise interest rates next week, but there's a camp that thinks they might raise one more time in November. Again, everything depends on the data. If the data indicates inflation is continuing to come down, they'll leave it. If there's some spike or the economy is suddenly roaringly strong, the chances are they may do another rate hike.
So, Bob, you mentioned the UAW strike, so let's go there next. What would this strike mean for investors?
Well, this is potentially a very big blow to the big three. Remember what's been going on here. The big three automakers are way behind a lot of other people. Look at Ford stock. Look at GM stock. They're disastrous. People have lost fortunes betting on Ford and GM turnarounds for 15 years. They're essentially zero in the last 15 years. Look at the chart. That Ford and GM essentially have gone nowhere. Zero over 15 years. That's pretty awful. And part of the problem they've had is competitors that are more efficient, foreign competitors, and then the rise of electric vehicles. I can assure you, Elon Musk is very happy about a strike because he is a non-union shop. So this makes it difficult. Ford and GM are trying very hard to streamline, make their operations more efficient, and get into the electric vehicle business, which is ridiculously expensive. Unions, for the most part, are fairly suspicious of electric vehicles, and there may be some good reason for that, because if you look at a Tesla, there are very few moving parts in it. It's made differently. It's an electric vehicle. So the supply chain is much different, much less opportunity for in manufacturers to be a part of it. That makes Detroit unions suspicious, and understandably so. But I think that's still largely where the future is. So this is very, very difficult time for the big three automakers. I don't want to weigh in on whether the demands are unreasonable or not, but 40% increase is a pretty large number for them to deal with. What it would certainly mean would be a dramatic increase in the cost of cars. Now, a lot of people may say that's worth it. I'm not going to wade into that debate, but it's a very pivotal moment now for the auto industry. By the way, if you're asking about the broader market, other people are watching this, particularly after some of the other negotiations that are going on. So that to the extent that anyone can get higher wage increases than inflation, that means inflation is going to get notably worse.
We'll definitely keep our eye on this and come back to you with any updates. So next up, Bob, and I always love to hear your take on real estate just because of your background. But this question was about commercial real estate. So are we in a commercial real estate bubble?
Well, we're in a deflating bubble in certain aspects of this, and I appreciate you asking that. Years ago, I was the real estate correspondent for CNBC, and I'm talking a long time ago, 1990 to 1996. And I became stocks correspondent in 97. But my original roots are all in real estate. My family was in real estate. My father was a real estate developer. My brother still is in the Philadelphia area. My wife's been a realtor for over 30 years. So I grew up in this business. I'm very familiar with what's going on. So on commercial real estate, there is a recession going on in office buildings, office REITs. You probably know that. There is a difficult time going on in a large part of retail real estate, particularly small strip malls, which are hollowing out very, very quickly. A lot of those are just going to be bulldozed, frankly. More interesting is the possibility for mid-level malls and higher-end malls where they have to re-tenant these malls. And there are all sorts of things being planned and tried here, including hotels, mini theme parks, anything where you can get people into a single space, anything other than a traditional department store. So in some of the bigger malls, you're going to see a lot of very creative things going on, including literally giant entertainment spaces where you can do a lot more. So I'm kind of happy about that. But there's a lot of other things going on in real estate that's very interesting. For example, data centers are continuing to grow. I mean, we've got to put when we say everything's in the cloud, well, that means data centers. And that business is growing. The warehouse business has been growing for years and years and years. Transportation hubs, this is what we call logistics. How do you move stuff around the United States? There's an entire science built around this. And it's wonderful to watch warehouses being built around important nodal points in the transportation infrastructure. So that's very exciting. So again, real estate is a big thing. It's not one thing. It's residential real estate and commercial real estate, as I said, broken down into many areas: offices, retail, data centers, warehouses, and they all have storage. Storage was a big business for a long time. Baby boomers have a lot of crap. And what they do is they downsize. They get out of their house, their 3-story house, and they buy condos, and they don't want to get rid of all their crap, so they rent out storage units. That's why that business is doing so well. By the way, I'm a baby boomer. I'm in that group as well. So again, always don't ever think of businesses as one thing. There are sub businesses going on in all of these. And it's just like the sub businesses going on in the stock market business. There's a lot of different things going on in the stock market. It's not just one thing. And learn to sort of think about that when you're interested in real estate.
All right, and then last up, Bob, yesterday ARM made its debut on the NASDAQ. Can you tell us more about ARM's IPO, and are we going to see more IPOs this year?
Yeah, we're going to see more. That's the good news. The bad news is I'm not sure if it's necessarily good news what's happening with ARM. So ARM took a modest haircut. The last round essentially indicated ARM was about a $64 billion company. They floated it. It was in the low $50 billion. The fact that the problem is the valuation. The stock trades at 110 times forward earnings, some crazy number. To give you an idea, is that rational or not? NVIDIA, which is a real AI stock, trades at 30 times forward multiple. Taiwan Semi probably trades, I don't remember, but 18, 19, 20 times. 110, really? And here's the other problem. I don't care what they say. They're not an AI company. They make chips for cell phones, smartphones. Okay, this thing, the Apple. They make chips. They are the primary. Their designs, I should say, not their chips. Their designs are in all the smartphones in the world practically. They are not a big presence in AI chip design. Now, whether or not that's going to matter in the future, I don't care. They say they want to be. Everyone says they want to be AI. Everybody. People who, Caterpillar wants to be an AI company. Everybody says that. That doesn't mean that it's going to be that. So they have a valuation problem, number one. And number two, they're in a space, which is cell phone business, that's not growing dramatically. Now, maybe they can pull it off. I don't know. Here's what I know. This is a really rich valuation, way out of whack with its peers. Okay. It's nice that it had a pop. What I'm more worried about is what happens in the subsequent weeks and months. And I'm going to tell you right now that this has been a problem all year. It's been a problem for several years. Companies, look, these companies want to price this as high as possible so they can get the most money, right? The problem is what happens to the poor investors who buy in on the first day and the subsequent days? They tend to lose. That's what happens. And if you don't believe me, I put up a stat yesterday. The average IPO this year is up 19% on the first day. After the first day, it's down 7%. That's the trade. So you're buying in at the top on the first day. If you're average schlub retail investor, CNBC viewer, average IPO, you buy in on the first day, you're losing after that because you bought in on the first day. You didn't get the initial price that the book runners sold investors to overnight. You bought in the middle of the day, and there you go. It's up nicely, 19%. But you bought it when it was up 19%. And subsequently, it trades down average 7%. Well, that's my worry about this company because the valuations don't make any sense. Now, Instacart had something different. They already took a really significant haircut. So they raised their estimates today, but they had their estimates are somewhere around, forget the numbers, about 10 billion for the value of the company. It was 39 billion in 2021 when they did a funding round. Now, think about this. Figure 40 billion. 40 billion to 10 billion, that's a 75% haircut. So that company's already had a big valuation haircut. They're going to float this thing at a much different price than if it would have been 2021. I think investors here, even with them trying to up the price today, I think they upped it to 28 to 30, and they were talking about 26 to 30. Even a higher price, investors have a better chance of making some money. Remember, I'm on the side of the people, the retail investors who want to buy into this thing. I'm not that worried about the company. We tend to think, oh, this is successful if Goldman Sachs gets a lot more money for the company. And nobody ever talks about the average retail investor that buys into this thing afterwards. I want to see the average investor make money. And that when they reach for the moon and price this thing at the sky and everybody gets all excited in the first day, and then the thing trades down a few weeks later and everybody loses money, nobody wants to talk about it because Wall Street is always involved in selling you the next hustle. And I'm more interested, excuse me, in seeing people. I want these companies to price lower, not higher. And I want to see investors make money in the long run. So Instacart, I'm more excited about Instacart, even with the higher price, than I am about ARM. And then you got Birkenstock and other people out there. We'll see. Birkenstock's a private company. Hard to figure out the valuation on that, but we'll talk about that later. There's other stuff. Klaviyo's next week, too. So the answer is things are starting to open up in the IPO market. The question is, what's the right price? And they better get it right, because if this stuff falls apart in 2 or 3 weeks, a lot of other companies are going to have a hard time.
Well, thanks for explaining that, Bob. And I think it's definitely helpful for investors to, know that. And we'll be watching Instacart and the others to come. And thanks again for answering all of our questions. As always, thanks to everyone for sending in your questions. Please leave a comment if you have a question for next time, and we'll talk again soon.
Thank you, Katie, and thank you, everybody. Sorry about the glitch there. We'll fix that next time. Take care.
Thanks, Bob.